Is the IndiaFirst Life money balance plan truly balancing risk and return, or just another ULIP with a fancy name? Let us find out the answer to this question through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand a few basic details about it. So this is a unit-linked non-participating individual savings life insurance policy. Some of the key features of the policy are: you have the flexibility to pay your premiums regularly for a limited term or through a one-time lump sum payment. And also this plan provides life cover to protect your loved ones in case of the life assured's untimely demise. With a built-in automatic trigger-based investment strategy, you can aim to optimize your savings. If you need funds during an emergency, then you can make partial withdrawals after the lock-in period. Additionally, you get to enjoy tax benefits as per the prevailing tax laws. So these are some of the key features of the policy, and there are benefits like maturity benefit and death benefit. And also, as a unit-linked policy, there are various charges that will be deducted from your premium, like premium allocation charge, fund management charge, policy administration charge, mortality charges, and discontinuance charge and switching charges. But there are no partial withdrawal charge, but still all these charges will be deducted throughout your policy term, continuously reducing your investable amount. Over time, this has a compounding effect, ultimately diminishing both your corpus and long-term returns. So you need to consider this as a drawback and think whether investing in this policy is worth it or not. So now let us take a look at the advantages. So you can enhance your base policy by adding optional riders for additional protection, and you get to enjoy the flexibility of making up to 2-3 fund switches. You get to enjoy the flexibility of making up to 2 free fund switches each policy month to align your investments with changing goals or market conditions. So these are some of the advantages. However, the disadvantages are: the plan offers limited liquidity during the first 5 policy years, restricting access to your funds. It does not provide any loan facility, reducing financial flexibility in times of need. The sum assured may fall short of adequately covering your family's essential financial needs, and additionally, high charges associated with the plan can significantly erode your overall returns. So these are some of the disadvantages that you need to keep in your mind before deciding to invest in this policy. So now, as we have a basic understanding about this policy, let us move on to the analysis part of the video, where we are going to conduct an IRR analysis by calculating the internal rate of return of this policy based on the benefit illustration given in the policy brochure to help us make a more informed decision. So for calculation purpose, let us assume that a 30-year-old male has purchased this policy with a sum assured of 10 lakh, a policy term of 20 years, and a premium paying term of 5 years. So he pays an annual premium of 50,000 rupees. At the end of the policy term, the fund value is paid out based on market performance. Here in this example tabular column, we have assumed returns of 4% and 8% per annum as given in the brochure, just purely calculative purpose, and they are not non-guaranteed returns. At 4% assumed return, the final fund value is 2.52 lakhs, yielding an IRR of just 0.05% as per the policy's maturity calculator, essentially no growth over the total premiums paid. At 8% assumed return, the fund value is 5.74 lakhs, resulting in an IRR of 4.72% as per the policy's maturity calculator, which is still lower than the return from a typical long-term debt instrument. Although the plan invests your money in market-linked funds, the returns in both scenarios fall short of what you would expect from a 20-year investment horizon. Given the low IRR, this policy does not appear to be a compelling choice for building long-term wealth or for meeting any of your major financial goals. So as this policy is not giving us a desirable outcome that we need, let us now go through a smarter alternative strategy where instead of combining insurance and investment, we are going to invest in both separately. So here we are going to invest in a pure term life insurance policy for a life cover purpose with a sum assured of 10 lakh, a 20-year policy term with a 5-year premium payment term, which would cost us an annual premium of 12,000 rupees. Compared to the 50,000 annual premium in the earlier example, this leaves us with 38,000 each year to invest and build wealth. So here we have taken some similar metrics to the previous policy for a fair comparison. So let's consider how this 38,000 rupees can grow if invested in a market linked product. For high in risk investors, equity mutual fund schemes are a strong option. So for a fair comparison, we have also taken a market linked product to compare. So equity mutual fund scenario, we can assume a long term average return of the investment will grow to 14.79 lakhs, which is the pre-tax value over 20 years. And if you apply the capital gains tax at redemption, the post-tax maturity amount is approximately 13.34 lakhs. This results in an IRR of 9.70%. If you have any doubts regarding how the equity mutual fund tax is calculated, we do have a small tabular column presented on the screen for your easy reference, which you can pause and see. So this approach not only beats inflation but also helps accumulate a much larger corpus to meet your long-term financial goals. In comparison, this policy yields significantly lower returns, which may lead to a shortfall in your overall target corpus. So what is the final verdict then? Is investing in the IndiaFirst Life Money Balance Plan worth it or not? So this policy combines life insurance coverage with market linked investment opportunities. While investors often choose such plans hoping to generate market level returns or even alpha, this plan here falls short. The returns are unable to beat inflation, defeating the core objective of market based investing. So the risk taken simply doesn't justify the underwhelming returns. Like most ULIPs, this plan comes with higher charges which significantly eat into the overall returns, and these costs reduce the plan's competitiveness when compared to other market linked products. In essence, investing in this policy may hinder your ability to achieve long term financial goals, and it also has a high agent commission. So a smarter approach would be to separate insurance from investment. So you can opt for a pure term insurance policy to secure high life cover at an affordable cost. For wealth creation, you can consider building a diversified investment portfolio aligned with your risk profile and financial objectives.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.